All right. So once again, good morning, everybody. We are back again on chapter 7. Who do I have here? All right. Chinyere, you're welcome. Good morning. Dede, Dr. Sonia, Ife, IJ. iPhone, please identify who you are. These other people, I know them. iPhone, who is on iPhone? Is it, it's no longer Chinanyam. Chinanyam has passed her exam. So who is on iPhone? Please, Mariam, you're welcome. Nancy, Kim, and Precious. So who is on iPhone? Please identify yourself. Who's on iPhone? Who is on iPhone? Please say something. Identify yourself, unmute yourself and say something. Every other person
My
here.
name is Frances.
Oh, Princess, you're welcome. Princess.
Frances.
All right, Princess, who is your business partner?
Wisdom Abukari.
Oh, Wisdom. All right. So
Yes, my name is Frances.
All right. So, Princess, when is the exam coming up?
Today.
Today. Oh my
Yeah.
God. All right. I wish you good luck. So we're gonna to just pay much attention to whatever we're discussing. But we're gonna get one thing or another. And you are coming for the first time today. Oh my God. All right.
No, I've been. It's my third time of joining.
Oh really?
Yeah.
All right. All right.
I was on last night and then the day before.
All right. I
It's
didn't
just that
know.
my work schedule don't allow me. I just came back from work, so I'm gonna sleep now. So it's tough to join, but yeah, I tried to join.
All right. All right. So all right. You're welcome. You're welcome. You're welcome. You're welcome. Just listen to what we're saying, what we're doing. Dede, good morning. Dede, how are you? Dede. Dede.
Good morning.
Good morning. Dede, have you been here before?
This is my first time.
Oh, this is your first time. Who's your business partner?
Vivian Osekwe and Sua.
Oh, Vivian.
Our
All right. Vivian. All right. When is the exam coming up?
February 18th.
Oh, all right. All right. So you're welcome. Here normally what we do is we try to make it a discussion class where everybody participates. Nobody's teaching anybody. What we are doing, we are doing a collaboration revision where everybody's part of it. So I'm just a moderator, and what that means is that you're gonna contribute to the discussion because the one you say out, you know it. Once you say it out, you know it. So what that means is that participate on the conversation and make sure you ask question when necessary. For any times you do not understand, please ask question. That will help you to understand it further. So we are on chapter 7, and I hope we're gonna finish chapter 7 now today. I believe so, so that we can go to group life insurance, which is chapter 8. So once again, remember that we have our upcoming championship ball convention, which comes up in Dallas on February 5th to February 7th. So you are required to be there. I hope who has not bought his ticket here in this platform, who has not bought his ticket. Royal Star made a promise to everyone, particularly you that are taking the exam, or you are in the process of taking your exam, or who have already registered for your exam. The promise Royal Star made is this: come over there, your hotel accommodation will be provided. But however, you're going to do that on time. It's about next week, so you're going to do that on time. Give us your name and your information that you have registered and you have bought your ticket. We provide hotel accommodation for you for those days that you'll be here in Dallas. So it's a good gift to anyone who will be there. And however, let me tell you, there's one thing I was speaking yesterday. Somebody said, "Oh, he has not passed his exam. That's the reason why he will not come." No, 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 no. You are now entered into this business. You are there already in the business. Every opportunity you have to learn, to understand what you're about to do, grab the opportunity. Do not miss it. So we're expecting that you will be in Dallas by February 5th to February 7th. Is a very good gathering. that you learn a lot of things. And again, you will see when we're talking about insurance company, you will see them, you will know what they do, you will see them speak to you, you will see them direct you on what to do. So that will mobilize you, give you all the enablement that will help you to pass and even to help you do the business. So it's not one-time affair. For you to succeed in the business, you have to be attending things that organize so that you learn. Any movement you go, you learn. And you meet people like-minded that will push you up to get to the level that you are aspiring to be. So it's not only about maybe until when you pass the exam. No. Identify yourself and you'll be identified. Remember, I said in this business, everybody, the people who are there before you will try to lift you up to grow. Nobody, like the slogans, we said, no family leave behind. In this business, no agent leave behind. As far as immediately identify yourself, you are going to do the business. You'll be hold hand, the two hands, and some other people will hold you on the leg. Make sure you are up. So please, you are expected to be in Dallas. All right, I think we have other event. That one is July, which is our national, is a worldwide event. That one coming in Las Vegas, July, where you see about up to 40 to 50,000 people in one hall talking about insurance. So that is another opportunity again. That one will be July. But for now, just attend the Plano, the Dallas event is in Plano Convention Center. February 5th. It's almost a week or two, close to 2 weeks or a week from now. So you're expected to be there. I hope to see everybody there. All right. We did chapter 7, and I believe we're going to finish chapter 7 today. We are about 70-something% to it. Yesterday night, we almost finished it, but let me see. I think we have done binding receipts. We are policy issue and delivery. I think something here. Who is here yesterday? Can you remember? I think, all right. I think it should be here. Policy issues and delivery. Is it where we are? Who can confirm? Anybody
Yes.
here?
Yes.
Yes.
We
Yes,
are
policy issue.
and delivery. So policy is that what when you buy an insurance, it's called you are buying a policy. So assuming you have finished everything, we talked about application from the beginning to almost when the application is no longer application. Of course, when the application is no longer application is that when we are saying that, look, they are not asking again about whether you are, please, if you're not speaking, just mute.
Here, one of the windows there busted out with some of the framing on the ground.
All right.
Side of the home.
So when the policy, from the time you start writing that policy till when you complete that policy, the one issue that will be in your mind is that, do I have insurable interest on this person? So we say insurable interest starts with the policy, with the application, and ends with it. So immediately the policy is submitted, there is no more insurable interest required. However, there is insurable interest asked for by the claim department. They want to know whether there is insurable interest exists. If you are the policy owner and also you are the beneficiary, and another person is insured, when the claim is being demanded, when you file a claim, they want to find out whether is there any insurable interest that exists. That is the only two times they ask for insurable interest. But if you are the policy owner and the insured, they don't bother to ask about insurable interest again. But if you are the policy owner and you are not the insured, and you are the policy owner, you are the beneficiary, yes, they will seek to find out whether there's insurable interest during the time of application. That's what they want to know. But however, we say that insurable interest starts with the application and ends with the application. So there must be insurable interest in any policy when you are the policy owner and not the insured. There must be insurable interest. And all of us here have known what insurable interest is and who those that you must have insurable interest for anybody at all you want to buy policy for. You cannot buy policy for a stranger, somebody who you do not have insurable interest. And we say for you to have insurable interest on anybody, you must have, if anything happened to such person, let's assume death or anything, you must have a financial loss or otherwise, or emotional. You must have financial loss on that death of that person. So that is the person you have insurable interest. Therefore, you have insurable interest to your children. You have insurable interest to your husband, your wife, your parents, your grandparents. You have insurable interest to them. You have another thing, you have insurable interest to your business partner. Because remember, if you have a business partner, you can put policy on the person equally can put policy on you. So you have insurable interest to them. To your staff, employees, you have insurable interest on them, and that's why you can have a key employee policy. So that is all. That's if you must have insurable interest before you write policy for anybody. That's just what the law says. You cannot put in policy for a stranger. No, it's not allowed. It's against the law. All right. So in this section, actually, what we're going to deal with is this application that have been completed, submitted to the underwriter. The underwriter finish it. Now the application information or the policy is now coming back to you. You, who is the applicant? That is the stage we are now. We have done everything. Remember we said the application, you can submit application with the initial premium. And you can also submit application without initial premium. And when you submit application without initial premium, it is called what? Trial application. I beg everybody should understand that. Now we said again that submitting application without initial premium have a different effective date. Submitting application with initial premium have its own effective date. That is what you should know. And the effective date for when you submit application with initial premium is that date that the application was written, that check was made, submitted. That is the effective date for that application. Therefore, if you are an agent and you have a customer or a client who come to you to write policy for the person, after a thorough education and customer needs that will be based on the type of policy you give the person, you finish writing the application. The next thing you should do is hurriedly, fastly submit the application and the initial premium. Do not waste time because there is so much implications that have involved if the application was not submitted as when rightly done and when required. If you do not, as far as the agent, the customer has paid his initial premium and did not submit the application on time, if anything happened, the agent will be in a very big mess. So submit the application immediately as far as you finish the application and the customer pays his initial premium. Now, we go to one application that you submit without initial premium, which means the application is written, submitted, approved before your initial premium is paid. That is when there is a contract. That is when you complete the consideration clause. Remember, we said there's three consideration clause. One consideration clause on the part of the insurance company or the insurer, and two on the part of the insured, the applicant. The part of the consideration clause in the part of the applicant we say is what? The application, which is called the statement, the statement which is called the representation, and what? The initial premium. That is the consideration clause on the part of the applicant. Now we go ahead to say the consideration clause, which is also the insuring clause of the insurer or the insurance company, is the promise to pay benefits. And that promise to pay benefits is conditional. It's conditional in the sense that that promise will be made when the applicant has a loss. So these are the things, small things you have to know. In fact, you have to know them before you enter the hall. It will help you to answer any scenario questions. So, right. So now let's come back to this policy has finished. Everything we are saying now has been concluded. It's having concluded. So what we are now is that this policy is in the hand of the underwriter. Remember, we have two types of underwriter. The feed underwriter, which is you, the agent, and also you are also called the producer. You are the agent, you are the producer, you are the feed underwriter. And we have another underwriter, the office of underwriter, which is the underwriter of the insurance company. Remember, as an agent, you are working for the insurance company. So at the point of you writing an application, it means that the insurance company is writing the application because you are the only person in the field that represent the insurance company. Remember, the process of underwriting starts with the field underwriter, which is you. So you may see it in the exam where they ask you what the process of insurance company underwriting. The process of underwriting start with who? It starts with the field underwriter. And who is the field underwriter? You. You are also called the agent or the producer. Don't be confused and don't get it twisted. Remember, when you go to hall, you may be seeing producer. Your head be telling you, no, producer is the insurance company. No, producer is you, not the insurance company. Please, that is one of the things that confuses a lot of people. When they see producer, they thought it is the insurance company. No, producer is you, the agent, and also the field underwriter. All right. So now let's step into the final step in establishing insurance coverage, which is the policy issue and delivery. Of course, everything is done now. It's now about the policy issue and the delivery. Most often, this is a very critical area which normally come with a lot of scenario questions, the policy issue and delivery. So this step transforms the application and underwriting decision into an active contract that provides protection. The essence of insurance business is to provide protection. So therefore, 80% should go to your protection portfolio. You have something, you have money today, you have your annual income, 100%, which is 100%. Divide it, say 80% and 20%. The 20% is allowed to be on your protection. Of course, however you want to protect yourself, for you to live a promising retirement, a good retirement that you deserve, you must always invest your 20% of your annual income in your protection. However you want to protect yourself. If you want to go and employ people to protect you, it's as far as that 20% go to your protection, that will give you what? A good retirement plan. So always try to make sure your 20% is not swallowed. I mean, it's not invested in some other thing. It must be in your protection portfolio. Then the remaining 80%, you can use it for anything you like. All those Lewis return and all those things you can do, yes. From your 80%, your mortgage, 50% feeding was come from the 80%. But for retirement, which when that time reach, you may not be able to work. It requires your what? 20%. So how you handle policy delivery can affect not only when coverage begins, but also your client's understanding of their benefit and your future business opportunity. This particular process of policy issue and delivery is something you must handle diligently. You do not need to mess around with it. No delay, do everything accordingly. So the section examine how policies become effective, the importance of proper delivery procedure, and the producer's responsibility during this crucial phase. So today we're going to learn about policy effective date, the practice of backdating, constructive delivery concept, and the requirement for explaining policy provision to clients. Remember, we have provisions, almost 23 or 20, 23 or what? Yeah, 23 provisions, and we have 11 clauses or something like that. So what those clauses and provisions do was to direct you on the business of insurance. In fact, the beneficial part of it is about the provision benefits the insured, and the clauses partly is to the insurance company. I think we learn that in the future. We learn that in the future so that we can get hold of it, what it actually means. So we are also going to do understanding the elements. We try to understand all the elements that is essential for producers because errors in the delivery process can affect when coverage begins, create compliance issue, or lead to client misunderstanding about their coverage. Proper policy delivery not only fulfills legal requirements, but also provide an opportunity to strengthen client relationship and ensure policy holders fully understand their coverage. So policy delivery is not something you have to joke with. You must have to follow it as it is and make sure that everything is done according to the law. So once this information has come to you, you have to be able to know about applicants, how can be reviewed. So the underwriter seeks to classify the applicant risk to the insurer. The evaluation is referred to as risk classification. Remember why underwriting was introduced. We have said that several times, why they are introduced, why they are in the business of insurance. They are in the business of insurance to make sure that they control or prevent adverse selection. That is the only reason why underwriting business come to insurance. Now, because of underwriting and to stop or prevent adverse selection, the underwriters introduce risk classification in approving or denying the policy. So any applicant must go through risk classification. So we're going to see all those ways risks are classified. And who does that? The underwriters. So applicant pose a risk so significant that they are considered uninsurable and the application will be rejected. However, most insurance applicants fall within an insurance underwriting guidelines and are accordingly classified as preferred, standard, or substandard risk. So for the benefit of your exam, you're going to base risk classification on preferred, standard, and substandard risk. Preferred, standard, and substandard risk. That is the three classification of risk. And based on this classification, your premium will be determined. Based on this classification, you will know whether you'll be approved or you will not be approved. Based on this classification, of course, you will know how much you're going to pay. Everything is based on this risk classification. So, and a lot of things are involved in the risk identification. So the underwriters go ahead to get several information to be able to determine which risk will be involved, where you'll be placed. One, they get your MIB, they get your APS, they get your the information on the application. Of course, they get your social life information. They get your hobbies, what kind of hobbies you do, the kind of work you do, your sex, whether you're male or female. They get all those put together, your age, which is most importantly. They get all those, they put it together to classify you based on those information they got. So on this information they got, they know whether you will be preferred, whether it will be standard, whether it will be substandard risk classification. However, when you start the business, different insurance companies have their own specific classification. You may see preferred elite. You may see preferred elite. So, but for this, for now, for you to get, for the exam purposes, base your risk classification on preferred, substandard, or substandard risk. So let's look at this example. He said, for example, Maria is a 35-year-old marathon runner with excellent health metrics, but a family history of heart disease. Her underwriter must weigh these competing factors when determining her risk classification. What are the competing factors in this particular example? Can anybody identify it? I want anybody to say something. What are the competing factors as far as this lady, Miss Maria, who is that 35-year-old marathon runner? What are
The family
Marathon
history
runner
also
and family history.
the family history, one,
of heart disease.
Runner, marathon
and her,
runner.
yes, her profession. So these are the two things that we must check. Of course, her age and what? Her sex. All right, they did not identify the sex, but by the name, we can assume she is a female. Her age is most important. The family history, which is heart disease, and her occupation. These are the 3 things or the 4 things we know now that's competing in this particular example. So from there, we can be able to classify her on which class she belongs. So let's go ahead. We are using that Maria to do this analysis now. So let's look at preferred risk. Preferred risk. Remember the 3 classification: preferred risk, standard risk, and substandard risk. Please just mute yourself so I will not be going up and down. All right. Do we have any new person here? Please, if you are new, just let us see you are new so that we want to know. If you are new, coming for the first time, because I know we are how many here now? We are 15. So if you are new, identify yourself if you are new so we can do the needful. For those who are new, I hope you are on the platform, on the group for the exam. So if you are not there, let us know, identify yourself so we can add you. So we're going to use this Maria situation, this issue, to be able to know, go through all this example. One of the number 1 classification is preferred risk. Second one is the standard risk. The third one is the substandard risk. Based on this classification, you'll be determined whether you'll be approved or not. You'll be determined your premium. That is the most important thing. Because why is the premium the most important thing? The premium determines how much policy you can lay your hand on. If you want to buy a policy now, probably you told the agent, look, I want $1 million. The agent, after the design, the policy as it fits your needs, the next thing you will ask the agent is, how much am I going to pay? I think that's the truth. That's the next thing you ask. How much am I going to be paying monthly? That guides how much you can afford. But however, we always advise people that instead of not getting nothing, get as small as you can be able to afford. So if the agent said $1 million policy, the next thing comes to your mind is, please, how much does it worth? How much am I going to pay monthly? That's the question everybody here will ask, even including me. I'll ask, how much am I going to afford? So that is it. Now, in preferred risk, many insurers reward good low risk by assigning them to preferred risk classification. Companies issue preferred risk policy with reduced premium due to the expectation of a better than average mortality or morbidity experience. One thing we did not say about the Maria case is the example is if his current status, his current health, that's what we did not do. Oh, and of course, they mentioned it here, he has excellent health metrics. With excellent health metrics, in as much as he has a family history of heart disease, for now, his own health is excellent. And however, she is a lady, a female, and she is 35 years old. And her occupation, she's a marathon runner. And she has a family of heart disease. You can correlate the two, heart disease with a marathon runner. You can see the danger there. So with that, as an agent, somebody tell you something like this, your mind will go first of all, without even when you have not written the application, and which you may not even discuss with the client. But after telling you all this, your mind will be asking, you'll be asking yourself, is this person going to be approved? And if he's going to be approved, what risk classification can he be? That determination help you at first to know what you're going to classify the applicant, because you have to first, or you, the field underwriter, have to first do the classification before you submit it to the field underwriter. When you get to before you submit to the office underwriter, you, the field underwriter, will first do the classification, then submit it to the office underwriter, the underwriter in the office. Then the underwriter in the office will look at the classification you gave to Maria, see whether this classification is good. If it's not, after getting all necessary information, the office underwriter will now do a proper classification. You may say Maria is preferred. You submit it in the application to the underwriter. The underwriter look at it. After examining this likely issue that will be in Maria case, the underwriter will say, no, Maria cannot be in preferred helix. I mean, preferred is better be on standard because of he's a runner and he has also family history of disease. The next question the underwriter want to know will be, if Maria has a family of history disease, let's look at the recent history heart disease in the family. The underwriter will ask, what about, is the mother still alive? Is the father still alive? What killed, if they are not alive, what killed them at what age? This is the three questions the underwriter want to know. Is the father still alive? Is the mother still alive? If they're alive, good. If they are not alive, what was the cause of the death? And if they are not alive, at what age they died? Based on that, the underwriter will look at the age of Maria, 35 years, and now let's assume the father dies about 80 or 90 years with heart disease, and the mother dies up to around 85 or 88 or 89 or even 91 years through heart disease. The field underwriter will say, oh, all right, Maria is 35 years old, and the mother and the parents died around 1995 and with heart disease. So Maria is likely to stay up to 90 years. Based on that, the underwriter may say, Maria should be put on preferred risk. Or, anyway, because of his work as a marathon runner, we don't know the occupation of the parents, but because he's a marathon runner, the likelihood of that to trigger heart disease may be there. Let me put him on the standard risk. That should be a final decision of the underwriter. And he has to go and get every health information about Maria. So when he got all those, he will now determine. Finally say, oh, we're going to put Maria on as a standard risk. And there is go. Maria now will be in standard risk. Meanwhile, you as the agent have classified Maria as a preferred risk because to you, he has excellent health metrics. But the underwriter in the office putting all these factors together said, no, Maria have to be on a standard risk. You can see the two classification. Now, what happened? Remember we said that you as the applicant, you made an offer to an insurance company. That's what we said. I hope everybody remember that. Who makes an offer? The applicant. Please remember that the applicant makes an offer. The insurance company will accept the offer. It becomes an agreement. Then before it's go over talking about contract or not contract. So let's assume this scenario happens that the underwriter in the office reduce the classification you made preferred. The underwriter now say no, it's standard. Remember, offer has met to the insurance company with a preferred what? Classification that you, the agent, the producer, and the field underwriter failed on the application. Then the field, because it's what it has now become an offer to an insurance company, but the field underwriter has gone along to see, the office underwriter have gone along to see that this Maria can no longer be in preferred risk, it will be on standard risk. What the field underwriter will do is, the office underwriter will do is to do what? To do a counter offer. That counter offer is reducing the classification from preferred to standard. And this counter offer will be on the policy that have been approved and delivered to you, to the applicant. Remember, what is originally in the application is no longer there. What is there now is what? Standard risk. So, as a counter offer to you, to the applicant, oh no, you offer us preferred risk. Now we can't take preferred risk because we can't cover preferred risk for you. We are now making a counter offer to you by what? Offering you standard risk. Then when that offer gets to you in form of policy delivery package, that policy will now come to you. This policy has been approved. It comes to you as in a box or in a packet. Policy delivery. It gets to your house. When it gets to your house, you go through it. They give you 10 days, a free look period. 10 days to go through that policy, which is the counter offer. 10 days to go through it. You go through those period within that 10 days, you'll find out that, look, I will accept it or I will not accept it. If you accept it, you sign a policy delivery receipt. And again, you may sometimes require what? Statement of good health. You sign these two things and what? Forward back to the insurance company, indicating that you want the policy, which means you have accepted the counter offer they made to you. Then what happens? The contract is now binding, no more changes. However, if you decide the time the package comes to you, that counter offer was made and delivered to you, you decide that, look, I do not want it again. What happened? You have to tell the insurance company, look, I do not want the counter offer. The classification, because of the risk classification you place on me, the standard, I want preferred, but now you put me on standard. I do not want. If you reject it, what happened? The insurance company say, thank you. They will give you what? Give you back the initial premium you paid. So this is how it goes. So that's the policy delivery issue. Now, the preferred risk is what many insurers reward good low risk by assigning them to the preferred risk classification. Companies issue preferred risk policy with reduced premium. So preferred risk is the most risk, is the lowest risk you can go into. Why do they reduce the premium? Due to what? The expectation of better than average mortality or morbidity experience. This person have a clean set of excellent health metrics, so you do not have anything to, there's nothing in your scaffold. At 35, he still have excellent health. That's very good. So some of the things they use that contribute to somebody having a preferred risk rating include what? Being non-smoker, non-drinker, and maintaining a good health weight. Weight is a very big factor in insurance business, weight. And even, of course, without insurance, you should understand that weight is something contributory to so many diseases, more especially when you have heart disease, you are not supposed to keep a heavy weight. So health is one thing they consider. After the general health analysis, they will have to go to your see what is the height. They want to compare the height with the weight. So weight is a factor. Sometimes they will deny policy because of weight. Maybe if the weight is more than required, they're going to deny the policy based on the weight alone, not even on the health condition, weight. So most often, the weight is what you have to consider. If it's much, I will ask the person to reduce weight before you go, before you apply. All right. So let's assume standard risk. Now we have talked about preferred risk. That person must be non-smoker. That person does not drink alcohol, non-drinker. That person must maintain a good health, a healthy weight. That is one of the factors. Of course, a good health metrics must be there. So that's a low risk. That's a low risk. That's preferred. Let's go to standard risk. And a preferred risk rate has the smallest premium, or we call it reduced premium, than every other risk. What premium reduction we're talking about is this. If Maria wrote this policy, maybe you are an agent, you wrote Maria policy. They give Maria policy, they give her standard. If maybe you wrote 500,000 and the premium is what? 500. That's what you calculated. By the time you put it on preferred, the premium is $500 every month, and the policy is 500,000 policy, and the premium you calculated initially was what? Preferred, and the premium is 500. Now, if Maria is reduced into standard, the premium Maria will pay will be what? 25% higher than this. 25% lower than the preferred. Higher than the preferred, which means standard of this one now may be around 750 for the standard. Let's assume we are just doing assumptions. That's not really what we are calculating. So, which means standard rate, premium rate will be higher than preferred premium rate. That's what I want you to know. Then substandard premium rate will be the highest of all the three. So let's go ahead. Let's look at the standard rate. But we have known that preferred risk right? You are a non-drug, non-smoker, a non-drinker, somebody who maintains a good weight and must have a good health metrics. Now, let's go to standard risk. First, it is important to recognize that standard risk serve as a baseline for all underwriting decisions. Standard rate is the term used for individuals who fit the insurance guideline for issuing the policy with just special restriction or an additional rating. This individual met the same condition as the tabular risk on which the insurer premium rates are based. So standard rates are what? The natural rates the insurance company consider in their insurer guideline for issuing policy. Now, let's go to substandard rates. What is a substandard rate then? In the contrast, comparing substandard rate with the preferred and the standard rates, a substandard rate or rated, you will always use the word, sometimes you use the word rated. Rated policy means that that policy is a substandard risk. Please know that whenever you see rated policy, rated means that this policy is on substandard, which means it have the highest risk level. A policy rated is on substandard risk. So is one below the insurance standard or average risk guideline. An individual can be rated as substandard for many reasons, including poor health, a dangerous occupation, attributes, and what habits that could be hazardous. Substandard applications are accepted for coverage with increased policy premium. So we're going to see the percentage of this standard, preferred, and substandard risk classification. We're going to see the premium. I know, and if I can remember vividly, when you have a preferred risk, you are either 25% or 15% premium lower than standard. Then the standard is the normal premium. The substandard is about 75%, either 65 or 75% higher than standard. 15 or 25% lower than standard, that is preferred. Standard is the normal. Substandard is 65 or 75% higher than standard. So that will tell you that if you are classified rated, means that you are substandard risk. And what does it show? That this person has the highest risk level. So declined risk. Any declined risk is a risk that is very, very insurable. If you're a declined risk, means that insurance company cannot cover the risk. Some applicants cannot be approved because the risk of premature loss is too great. In such cases, underwriter must decline the application. So whenever you are declined, it means that your risk cannot be insured. You are very close to a loss, premature loss. But however, most often, does it normally apply like that? Because some people can be declined, they all remove everything they had. They hope that, oh, they are dying. That is not the issue. That is not the issue. Of course, some people have terminal illness, still come up, still survive, and still walking freely with good health until they live as they can. You can equally have a substandard risk, and God keeping you still live to the fulfillment of the age you want to live in this life. But in insurance, otherwise, you may not be approved. Does it mean that you are dying? Of course, no. Yes, of course, you have a risk. You have a general risky head. Does it show that you are dying? Of course, no. So when you are declined, it means that the risk is insurable. It cannot be measured. All these things, what I want everybody to know that all these things we are talking about, risk, standard, preferred, and substandard. Before the underwriters was introduced, it wasn't like that. That's what I want everybody to have in your mind. Before the introduction of underwriters, risk classification was not implemented, was not there. So the underwriters come into insurance business and introduce all this. And why do they do that? They want to prevent adverse selection. So in case in the exam, you may see something like that. What do they do? That they want to prevent adverse selection. is the fight to prevent adverse selection. So please, I want everyone to always remember that why the underwriters come into business of life insurance. It was not like that before. So let's look at unfair discrimination. Of course, you do not practice discrimination when you are as regards to life insurance. If your sexual orientation, religious preference, or your geographical location are prohibited life insurance underwriting factors because they are unfairly discriminatory. So what it means that as an underwriter, you do not base on your classification based on what sexual orientation, religious preference, geographical location, or any other factors as regards to unfairly discriminatory. More especially, the life insurance has structured it that, for instance, for sexual orientation, it's structured in the way that's either male or female. That one is basically, that's what is here. And you do not say, oh, this is religion, and this person is another religion, no. Or this person living this place, this person, no. Those factors are not there. So you have to remove it totally. Or if you have to choose the client you attend to, no, you attend to anybody who comes your way. As an agent, you do not have the right to do unfair discrimination. So it's not tolerated here in insurance business. So let's look at this. Which internet is unstable? Is it my internet? I beg. All right. So smokers are statistically more likely to die at a younger age than non-smokers. Everybody knows that when you are smoking, you are posing almost at the point of getting a heart issue. So that one is what is a consideration in the life insurance underwriting process. Immediately you are a smoker, it reduces you to, if you are preferred, the final you're a smoker, automatically reduce you to maybe substandard. So it is important to recognize that not all forms of discrimination in insurance are considered unfair or illegal. Insurance companies are permitted and indeed required to classify applicants based on risk factors that affect the likelihood of a claim. These classifications, such as age, medical history, occupation, lifestyle habits, are designed to ensure that the premium rates accurately reflect the level of risk associated with each group, sometimes referred to as class or insured. Such legal discrimination allows insurer to remain financially sound while offering fair premium to all policyholders. Distinguishing between legal and unfair discrimination help clarify why certain questions and ratings are standard in the underwriting process. So, if you call it discrimination in finding somebody's medical age, medical history, occupation, and lifestyle habits, the life insurance, yes, is allowed. The insurance company use it. If you should call it discrimination, yeah, they are allowed to use this kind of risk discrimination to be able to ascertain the person's risk level. All right. So, for example, let's assume charging higher premium to smokers or those in hazardous occupation is permitted because statistically, evidence shows these people present increased risk. So let's look at the exam tip. So we often hear discrimination against protected class is illegal, related to employment, housing, education. Of course, in real estate, it's always there. We always told that discrimination against protected class is illegal. That's what is, and of course, it's always there. That's the first thing they tell you. If you're a realtor, that's the first thing they tell you. In terms of housing, yes, it's very, very illegal in terms of housing. Of course, in employment, it's also very, very illegal. In education, it's very, very illegal. So most of this holds true for insurance. However, not every class is protected class. Be careful not to immediately apply the negative motion tied to discrimination to exam question. So, you see what it's telling you? Because sometimes we read meanings based on our community understanding of facts. But most often, it's not applied when you are writing exam. Do not add any things that's not supposed to be based on your own emotion to the question. No. No, do not. As we go forward, we see those things that can make you think, that use your emotion to answer the question. Do not. Go straight on what the question says and follow it as it is said. For this classification, here they have told you that discrimination is illegal. But however, a discrimination in terms of somebody's, this person using tobacco, this person age, gender, all those, yeah, there are classification that can be used in determining the person's risk. Look at, it said their impact to mortality rates are example of fair and legal discrimination that is permitted and necessary throughout the insurance industry. So, or what age are you? What's your gender? Yes, it's questions you have to ask. But are you going to ask somebody who comes for employment, you ask him the gender? You say, if you like, answer. If it's not, that's why in gender questions in employment, it's not mandatory. That will answer. It's optional. If you check somebody who has filled application, you see that it's very, very optional for you to identify your gender. Yes, of course, but for here, it's something you have to ask. It's needed. Of course, age. You have to ask age. It's needed. So these are some things that we describe as discriminatory. That is very illegal in housing, education, and employment. They are very, very illegal. But for insurance business, yes, they are protected class. You must consider them. So this is something you have to know. When we talk of discrimination, understand where it will be used and where it will not be used. So we're gonna go through this and check which of them is. Let's follow 3 applicants. 3 applicants, each of them have their own risk classification. First of all, let's look at why we must consider somebody preferred. James is 42. James is a non-smoker with excellent health metrics. He doesn't have any health condition. His BMI is 23. Blood pressure is what? 118/75, and cholesterol level well within normal range. He exercises regularly, has no family history of early heart, cardiac death, or cancer, and works in a low-risk occupation. The underwriter classified James as a preferred risk, resulting in premium 15% lower than the standard risk. All right, look at what I want to say. 15% lower than the standard risk. James, you can see that James have a good health. The BMI is 23. It doesn't have a bad weight. So these are some of the serious things that the underwriter consider. Now, let's look at applicant 2, Diana, who is on standard risk. Diana is 39 years, has generally good health with a few minor concerns. Her BMI is 27, slightly overweight. Remember, for BMI to be, the average good BMI is, I think, 25. 25 is the acceptable good BMI. Then from overweight, I think 26.5 or 25.5, something like that, is an overweight. So this lady, Diana, is what? Overweight, slightly overweight, 27 BMI. And she takes medication for mild hypertension that helps her, keeps her blood pressure controlled at 135/85. She doesn't smoke and has no hazardous hobbies. The underwriter classified Diana as what? Standard risk, qualifying her for a normal premium rate, which is normal premium rate will be now 25% lower than preferred. So, 15% lower than preferred. That's what Diana is, because she was standard. Now, Marcus, let's look at substandard. Marcus is 45. Marcus is a smoker with a BMI of 33, which is Marcus is obese, big. He has type 2 diabetes with inconsistent A1C readings between 8.0 to 9.5 over the past year. His father died of heart disease at age 52. Marcus worked as an electrical lineman, an occupation with elevated risk. The underwriter classifies Marcus as a substandard risk with a table 3 rating, increasing his premium by 75% above standard risk. So you can see that when you are substandard, you pay 75% above the normal premium. When you are preferred risk, you pay 15% below the normal rate. They have a rating table that all those classifications are based on. So if you are approved if some application is approved, and you are preferred, what it means that your premium now is 15% lower than what the premium would have been. If you are standard, your premium becomes that normal premium. If you are substandard, your premium will be 75% above standard, which is above the normal premium. So you can see that your classification will determine the type of premium you pay, the amount you pay. So, and of course, that will guide you on the policy amount you can be able to afford. Any question? Any question? All right, so that's a risk classification. There's no need to go through it again. All right, now let's look at the policy effective dates. Any question here, please? Any question asked? If you have any confusion, ask. Let's see whether we can clarify it. Any question or any clarification on what we just said or what we have finished on risk classification? All right, so let's go to policy effective dates. The date that we say this policy started. So in any life insurance sale, an essential question is, when does the policy become effective? Of course, that's the question me and you will ask. When did this policy start? For instance, you have health insurance too. The first question you ask yourself is, when does this policy start? So the effective date is important for two reasons. Not only does it identify when the coverage is effective, but it also establishes the date by which future annual premium must be paid. Let's assume that the receipt, either conditional or binding, is issued in exchange for the initial premium payment. In this case, the receipt date will generally be noted as the policy effective date in the contract. Remember what we said, you can submit an application without initial premium and you can submit with initial premium. The one you submit with initial premium already has a date the premium is paid. It has the date the premium was paid, the date of application, the date that check was signed, and the date submitted. Normally, you are expected not to waste even more than 1 hour. When a premium is going with applications, submit it immediately. So that date becomes the effective date of the contract. So if a premium deposit is not given with the application, the policy effective date is the date it is delivered to the applicant. Did you see that? So please, I want everybody to get this, because it's in the issue, it's something you must know, and probably you may see it in the exam. I want everybody to get this. We have two effective dates now. Effective date. One, the effective date when you submit the application with initial premium. The effective date is what? That date that the contract, that date that the policy was written, the application was written and the check was written, and you submitted that day. That should be the effective date of that one. But in case you submit the application without depositing initial premium, then the policy effective date is the date it is delivered to the applicant, and the first premium is collected, along with statement of continued good health. So, did you see something here that may confuse most of us? One is, remember the two ways of application. One, you submit with initial premium, and the other one is submit without initial premium. The one that's coming to confuse us now is the one you submit without initial premium. The one with initial premium, we have already identified the effective date. Is that correct? Please, I hope everybody's hearing me.
Yes, we are hearing you. That
All right.
means effective date is attached to the day premium is paid.
Of course, that's what I'm trying to say. But however, let's look at the second one, which is the one you submit without initial premium. That is the one that's giving us confusion now. The one that you have submitted with initial premium, we have already identified the effective date. So watch here. What they are trying to tell us. If the premium they said if the premium deposit is not given with the application, which means premium was not paid with the application, the policy effective date is what is the date it is delivered to the applicant, and the first premium is collected along with statement of continued good health. So I want you to remember something, that the normal thing we do, and which any of you that have written application, policy, will remember, is this. You submit the application with the agent, and you stay for some time. The agent, even for 2 days or 3 days or 1 week or 2 weeks, the agent now called you, or the insurance company sent you to email, an email said that your policy has been approved. They will now demand for you to pay the initial premium. You paid. So what this is telling us is that the effective date is that date you pay the premium. But again, it's telling us that the effective date is the date, policy effective date, the date is delivered to the applicant. Remember, we are dealing with delivery of the policy. Remember, the delivery of policy is the time the package comes to you. And before the package comes to you, you must have already paid your premium. So the date the first premium is collected is the effective date of the policy when the premium was not submitted, deposited with the application. The first premium date, the date the first premium is collected, is the effective date. You should know that. So please, let's not confuse you. Again, if in the question, they did not write the first premium is collected, they write it is delivered to the date it was delivered to the applicant. That remains the effective date. Again, remember, you can submit a statement of continued good health. When do you submit a statement of continued good health? Is when after the free look period. Is that true? I hope everybody is following. So the date you submitted the statement of continued good health is what? They said it can be the effective date. But I want everyone to have it in mind that the effective date remained the first day the premium was paid. Keep that one in your mind. But in case you did not see it in the exam, in the option, you are seeing the date policy was delivered. The date it is delivered, the date policy was delivered. Yes, you see the effective date. So this is what they're saying here. So I want you to know all this so you don't get confused when you get to the hall. So let's look at the exam tip. It says you may see a
Hello,
question.
sir.
All right, go
Excuse me,
ahead.
sir. I have a question. Assuming the policy is delivered and still the person didn't pay any premium yet,
No,
will it still be considered the effective date?
no, they cannot deliver policy to you without you
Policy
paying
without premium. Okay.
premium. Remember, the premium now means that you have fulfilled your own consideration clause.
Okay.
So there will be no contract. There are no contract without a premium.
Premium.
Yeah. So
Okay,
let's look at this example. It said, you may see a question that asks about the effective date of a life insurance policy. Ironically, the effective date of a life insurance policy, unlike for other types of insurance, is never the date of the policy is issued. So I want everybody to pay attention. Never the date the policy is issued. So what will be your mind? What date that this policy premium was paid? So if the premium was paid with the application, the policy is effective as of the date of the receipt or medical exam. So remember, we are dealing on two things. One, when the policy was delivered with, submitted with premium. When it's submitted with premium, the effective date remains what? The date of the receipt of the application and the receipt of the premium. Or two of them supposed to go together because two of them was done together. Or if there is issue of medical exam, for instance, when you submit the application, this person, before the approval, they have to go to look for any medical exam. If there's need for that, then the effective date becomes the date the medical exam was submitted. So this is what you should be on your mind. The receipt or the medical exam, that is the effective date for when the application was submitted with initial premium. Now, if no premium was paid, which is the one you just said, if no premium was paid, which means no premium was submitted with the application, then the policy will not be effective until the first premium is collected, which will be after the policy issue date. So policy issue date is never the effective date. That's what they want you to know. The date the policy was issued is not the date of the, or is the effective date. That's what they know. Of course, they said it here that never, all right, unlike for other type of insurance, it's never the date of the policy is issued. So the policy issue date is never the effective date. The effective date is the date the premium was paid, is the date the premium receipt was received, or the medical exam. These are the three things you should know. Please, you may see them in exam, so don't get confused. Now, let's talk about backdating. Why do you do backdating? And why backdating, it might be necessary to some people, and why isn't it necessary? Or if it's necessary, what actions are followed? So backdating, literally backdating means that policy, let's assume we write policy today. Today is January.
Professor Bath.
Go ahead.
Question here.
Mm-hmm.
The date policy was delivered is not the effective date. That's what you're saying.
All right. We have three options there. One, when the policy was delivered with, when the application was delivered with initial premium, the effective date is the date receipt has, which is that conditional receipt you gave. That date is the effective date. Or otherwise, if there's any examination to be determined, that becomes the effective date. Again, when the policy is not submitted, is not delivered, application was not submitted with the initial premium, the effective date will be the date initial premium was received, not the date of issue. Did you get it?
But the policy would not issue unless the premium was paid, innit?
Of course, the policy will not be issued unless the premium is paid. You know that.
All right, gotcha.
Yeah. All right. So let's look at backdating. Backdating is like you write application today and your age is you are 35 years today. Now, when you are 35 years today, and when you are writing the application, you tell the agent that, look, you want to backdate the date, which means you won't assume that you wrote the application December. Remember, in December, you are what? You are not 35 again, you are 34 years. Not that you are writing the application today and you are 35 today, January 27. Now, you want the application to be backdated to maybe around 2025, maybe around June 2025, around September 2025. In that September 2025, you are not 35, you are 34 years. So that is what we call backdating. So when you backdate, what happened on backdating? You have to what? Pay the premium from that September till today. Is that clear? You have to pay premium from that September to today to meet up to this day that you backdated to. So that your application now will be 27th of September, no longer 27th of January. So you have to pay the premium for month of September, October, November, December, and January. Before your application or your policy will have that date 34 years old, no longer 35 years old. So that is backdating. So keep in mind the premium required to support a life insurance policy are determined, of course, is determined in part by the insured age. How much you pay requires the age, determined by your age. In essence, if the premium, which is the amount you pay for your policy, is determined partly or partially determined by your age. What does it that shows you? That shows you that if you go up to the after this, if you have not written policy for your children, that is the first thing you do. Because the lower the age, the lower the premium. So means that you not waste time to say, I will do it tomorrow, I'll do it next tomorrow. Any day added will increase your premium. Because you can see what he said here, that premium in a life insurance policy are determined in part by the insured age. So your age is in fact the main thing that's into consideration when they determine your premium. And you do not want to pay much premium. You want to get $1 million policy with a little premium. That's the target of everybody. And if that is your own aspiration or what you want, you must have to do it now, not tomorrow. So what does that mean? Your children who are still very, very young, 5 years, 6 years, 7 years, 20 years, 30 years, this is the right time for them to get it. If you're 50 years, this is the right time to get it. At 51 years, the premium you're going to pay will be more than what you pay in 50 years. That is correct. More especially, the premium increases if you're male. So age is a big factor. So the purpose of backdating, why do people want to backdate a life insurance policy, is to what? Use premium based on an early age. So remember our example before, that you are 35, you want to write it at 34. The premium at 34 is not the same with the premium at 35 years old. No. They're different. If you go there, maybe close to $100 difference or $150 difference. That is the truth. So that's why if you're older, your premium will be higher. But if you're younger, your premium will be what? Lower. So you backdate to lower the premium. That's what you do. You backdate to lower the premium. That is the essence of backdating. So many insurers are willing to let an applicant backdate or save age. So you backdate to save age in a policy. However, some condition must be met before this step can be taken. First, the insurer must allow backdating. Second, the company typically imposes a time limit on how far backdate a policy can be backdated, generally 6 months. So you can only backdate for 6 months, which means you cannot backdate more than 6 months. So the next premium is due at the backdated anniversary date. So if you backdate, you cannot backdate more than 1 year. If today is January, you want to backdate, you can only backdate 6 months from January, that is 6 months behind. You cannot backdate more than 6 months behind. So why do you want to backdate? Because you want to lower your premium. You want to have your premium based on that early age, which is the age you want to backdate to. So that's what backdating is. So after the underwriting is complete and the policy is issued, the insurance contract is sent to the sales agent for delivery to the applicant. The policy is not typically sent directly to the policy owner, since as an important legal document, it should be explained to the policy owner by the agent delivering it. The agent must also secure a signed document from the delivery owner that identifies the date the policy was delivered. The free look period commences on the date of delivery. Did you guys hear it? The free look period commences on the date of delivery. And what's that free look period? We say 10 days for when it's delivered by the agent.
When it's
delivered to your
delivered,
hand. And
and
30 days
30 days, mail.
when it's delivered by mail. So please remember that. So let's look at this. Say, remember, let's look at the exam tip. It says, remember that the free look period typically lasts 10 days, 30 days for mail order policy. Mail order policy means that when that policy was delivered by mail, 10 days when that policy was delivered to you by the agent or the insurance company itself. So these are the things you have to know on free look period. All right. I think some state has a free look period. Let's see. It said some questions on the exam might ask about the length of the free look period in your specific state. So in case for your state section, please check the free look period for your specific state. When you're reading your state material, check the free look period. Normally, my advice to everybody is that take a paper or a note. Whenever we see anything period, like the free look period, write it down Write what it means and write the date. We have a lot of things regarded as period. We have free look period. We have elimination period. We have a lot of periods. In fact, I don't want to. In fact, it's more when we go to heads, the head section. So take a paper as we see free look period. Write it down. Write the state. We have state free look period. Write the date. How long the free look period in your state. Write it down. That one you have to do it by yourself. When you're reading state section, do it. And if you can see, it's indicated here. It says some questions on the exam might ask about the length of the free look period in your specific states. So which may be different. States, the general rule covered are what? All right. State-specific rules are covered in the latter chapter. Don't fall for this common trap. Determine if the what question refer to your state-specific rule or the general rule covered by here first, then answer accordingly. Remember, the general rule is 10 days when it's delivered to you by the agent and 30 days when it's delivered to you by mail. That's the general rule. But again, go to your state and find out what is the specific rule in your state, the free look period in your state. So that's why you should write it down, be able to determine that. I think we are almost done. So that's what you should know. The constructive delivery, policy delivery, just policy coming to you from the agent or from the insurance company. Mailing is 30 days. We should know that. So that's what you should know here. There's not much more we're going to see here. Explaining the policy and rating of a client. Rating in clients, we talk about the 3 types of risk rating. We talk about what the preferred, the standard, and substandard. We say preferred is 15% lower than standard, and standard is a normal premium, and substandard is 75% higher than standard. So that's what you should know. Explain the policy and rating of a client. It's only by personal delivery a policy does the agent have a timely opportunity to review the contract along with its provision, exclusion, and rider. So when you write a policy for somebody, when that policy was delivered to the client, it's your duty as an agent to go back and review the policy with the person. That's what it's saying here. Review the policy. On that policy, be able to explain to him further everything about the contract, the provisions, the exclusions, and the riders. If there's any rider in the policy, you have to explain to the agent. I mean to the clients. So he said, in fact, some state most insurer require policy to be delivered in person for this very reason. Whether you deliver it through you or by mail, always recall to make sure that you educate the client about his policy. And that's the more reason why some of them, some of us are here. When that policy is explained to you, you understand the policy you have. And based on that, you may say, oh, I can do this thing that this person is doing. I want to join the business. So you have to explain that to your clients. So explain the policy and how it meets the policy owner's specific objective, helps avert misunderstanding, policy return, and potential lapses. So these are the things you're gonna explain. So when that policy is delivered to the client, you explain the policy to the person. What does it do? That single act, that's what we call policy review. So that single thing you do in the policy review will help avert what we call misunderstanding. Some applicant does not understand the policy yet. But if you do the policy review, what happened? They will understand every misunderstanding that will come their way. They will now understand that should be a lie. They will understand there is a policy return, and they will understand that it will prevent from policy lapses. So these are the things you should explain to the client, and it's called policy review. So after the policy is delivered to the agent, to the client, please make time to do a policy review based on their understanding of what we are doing and the policy itself. And that's the reason why you should understand the policy even before you write it for somebody. All right, I think this chapter is gone. obtaining a statement of the insured continuing good health. Remember, this statement of good health, when the policy is delivered to you, during the free look period, this statement of good health have to be obtained. This statement of good health represents the gap between when you submit the application and when they have gone to check your health, they confirm that you are of good health. From that period to when the policy was delivered to you, and you go through the policy and submit back to them. So that 2 or 3 days or 4 days or 1 week or 1 month, as case may be, is why you should give them the statement of good health. So when the policy is delivered to you, you have to sign the delivery receipt and most times the statement of good health and submit back to the insurance company. So then that they will say there's a contract. He said the agent will then submit the premium along with the signed statement. So this one, I don't want us to get confused here. This one normally occurs when you even pay the premium. He said they submit the premium along with the signed statement. So the policy first issued to you before you send the premium. I don't want us to go there at all, as I said, we not get confused. All right. This is a chapter summary. So basically all that we have been saying since. All that we've been saying. So let's watch the video so that we can end this chapter.
Congratulations on completing the life insurance underwriting and policy issue chapter, a key part of understanding how life insurance works behind the scenes. This section covered the essential steps insurers take to evaluate risk and issue policies, giving you a solid foundation to move forward with confidence. Let's take a moment to review what you've learned and reinforce your understanding before moving on. Underwriting isn't just a back-office process. Agents play a vital role as field underwriters. They're responsible for completing applications accurately, collecting initial premiums, and making sure clients receive all required disclosures. This frontline involvement helps ensure the insurer has the information needed to make sound decisions. You also learned about insurable interest, the financial or emotional connection that must exist between the policyholder and the insured person at the time of application. This requirement ensures that life insurance serves a legitimate purpose, not a speculative one. Without insurable interest, a policy could be seen as a wager on someone's life, which is why insurers require proof of this connection before issuing coverage. Understanding insurable interest helps future agents recognize the ethical and legal foundation of life insurance and prepares them to explain it clearly to clients. Here's a question to think about. Can an insurance producer be the beneficiary of a life insurance policy? Yes, as long as they have an insurable interest in the insured. We also looked at how underwriting plays a critical role in protecting insurers from adverse selection, a situation where individuals with higher risk are more likely to apply for coverage.
Please, you see this thing that's here? I want everybody to screenshot this. Just use your phone and take a picture of this. I want everybody to take your phone, take a picture of this. I hope everybody's hearing me. Yeah. Please take a picture. Take a picture of this. It's a good summary of what we just said about risk. All right. So I hope everybody has done that.
Wait.
You want me to go ahead?
Yeah.
All right. So let's go ahead.
Proper evaluation, this could lead to financial losses for the insurer and unfair premium rates across the board. To prevent this, the underwriting process gathers and analyzes a wide range of information. It starts with the application, which provides basic personal and financial details. Then medical exams and attending physician statements, APS reports, offer deeper insight into the applicant's health. The Medical Information Bureau, MIB, adds another layer by flagging any inconsistencies or prior insurance activity. Together, these tools help underwriters classify applicants accurately, ensuring that premiums are fair and reflect the level of risk.
Do you guys know that
this process not only
when you submit that application and the underwriter go to get your APX report, which is physician's note and medical history, and go to your MIB to check if you have written application before and that application was rejected. If you have submitted a life insurance application and it was rejected, was denied, it will automatically appear on the MIB. Let's assume you have written application in Transamerica. Transamerica denied it. Now you write and you go write another one in National. The underwriter in National want to check your MBI. The underwriters in National on the MBI will see that your application has been denied in Transamerica before. So it's always changed. All right.
Only protects the insurer but also supports a stable and ethical insurance marketplace. You also explored the 3 key parts of a life insurance application, each one playing a specific role in the underwriting process. First is the general information section, which gathers basic details about the applicant like age, occupation, and coverage amount requested. Next is the medical history section, where the applicant discloses past and current health conditions, medications, and family medical background. Finally, there's the agent's confidential report, a section not seen by the applicant. This is where the agent provides personal observations, notes any red flags, and gives insight into the applicant's overall presentation. You also learned about how statements on life insurance applications are treated. They're considered representations, not warranties. That means applicants aren't expected to be perfect, but they are expected to be materially accurate. In other words, the information they provide must be truthful and relevant to the insurer's decision-making process. This distinction matters because it protects both the applicant and the insurer. It allows for honest mistakes without automatically voiding the policy, while still holding applicants accountable for providing accurate and complete information. You explored how premium receipts determine when coverage begins. A conditional receipt provides coverage if the applicant proves insurable as of the application or medical exam date. A binding receipt guarantees coverage from the moment the application is signed, even before the insurer makes a final decision. This temporary protection remains in place during the underwriting process, offering peace of mind to the applicant. However, binding receipts are rare in life insurance because of the high risk involved. Most insurers prefer conditional receipts, which only provide coverage if certain requirements are met. Once underwriting is complete, the policy is issued and delivered, a critical moment for client understanding and trust. You also learned about constructive delivery, where giving the policy to the agent counts as delivery, even if not handed directly to the client. Don't forget the free look period, at least 10 days to review and return the policy for a full refund. These include HIPAA privacy notices, which explain how medical information is used, disclosure requirements, which ensure clients receive clear and complete policy details, and the Fair Credit Reporting Act, which gives applicants rights when their credit history is reviewed. Together, these safeguards promote transparency, protect personal data, and help build trust between agents and clients. These principles provide a clear structure for how life insurance is underwritten, issued, and explained. They give future agents the insight needed to navigate real-world scenarios with accuracy and professionalism. You're making real progress. Next, review the key notes, take the practice quiz, and get ready to apply what you've learned in real-world scenarios.
All right. So let's firstly take the exam, then we end for today. Let's take the exam so that in the evening we start with chapter 8, group life insurance. So we have 17 questions. Remember, the best way to pass this exam is to look at the options given to you. Do not waste your time because there's no time. The time is 150 minutes in this exam. So what it means that you have to use your time judiciously. So in every question, we have 4 options to be considered. Then if you look at the options and look at the question, you read the question, now you read the option, you see that, look, there are some of the options that's very, very irrelevant to the question. Do not waste your time on them. Neglect them. Those options that are not relevant to the question, go to consider the options that are relevant. More especially, practice the use of elimination in eliminating 2 options out of the 4 options. The essence of using the elimination method is what? To help you in case you are going to make a prediction or make a guess of the option. If you're making a guess between 2 options, you have a very high chances, 50% chance of guessing it correctly than when you are guessing within 4 options. No. Eliminate 2 options first and guess. If you do not know the answer, guess 2 answers, between 2 answers. The likely answers, guess between them. That will give you a high chance of getting it right. So do not guess in 4 options. All right. You can see that I told you that this question, this particular chapter, chapter 7, involve a lot of scenario questions. Scenario questions is questions that are not asked directly. Scenario questions, you must understand what they're trying to say. So let's look at this one. I said, Agent J, let's say Agent Janet, takes an application and initial premium from an applicant and send the application and premium check to the insurance company. The insurance company returns the check to Janet or J because the check is made out to Janet instead of the insurance company. What action should Janet take? So you can read it to your own understanding. Then let's do it fast and go. I want everybody to make it a discussion, everybody contribute, so we can do it fastly and do it for the day.
The option A.
Any other person?
A.
2 persons said it already. So I hope everybody understands this question. This is since morning. That is exactly what we're talking, what we are shouting on. That this applicant, Janet takes the application with the initial premium. So he takes the application with initial premium from an applicant and send the application and premium check to the insurance company. The insurance company now returns the check back to him or her because the check was made to her instead of insurance company. So the action you, what would that agent do, which is Janet or Jay? He has to return to the customer, collect a new check made out to the insurance company, and send the new check out to the insurance company. You cannot make the insurance company to the check to the agent. The agent is not the insurance company. The agent represents the insurance company. So, which of these factors do not play a role in underwriting of a life insurance policy? Which of these factors does not play a role?
C.
Marital status.
So 2 persons say C. Of course, marital status, we have credit status is checked. A vocation is your hobby. Occupation is your work, the kind of work you do. So this one says an applicant's medical information received from the Medical Information Bureau, MIB, may be furnished to the what? Who are we going to give applicants medical information?
So I wanted to be vice president. And so I wanted the chance to share my stuff. So, Kawa wrote.
So who are we going to give the application, the information?
D.
I'm going to say something on this particular, somebody said D, any other person? Any other person? Right, let's follow this guy and this lady. It's D. Yes. Let me say something on this. I want to say something on this. This answer, me too, I do not believe in this answer, but it's the answer. If you If you are the underwriter, office underwriter, is the office underwriter that go for this MIB, which is Medical Information Bureau. He get this information for him to use on seeing whether he can approve or deny the policy, the application. Now, in this MIB, you still have some part of APS, which is information from the doctor. The information from the doctor, there's the APS the underwriter go for, is the recent or the recent visit and the notes of the applicants, medical notes of the applicants. But every other disease concern that the applicant has is already on MIB. It's already in MIB. So the underwriter cannot go and get this information from the MIB to come and give it back to the physician. So this particular question and answer is doubtable because the underwriter cannot get the MIB information and come back and give it to the source where some of the information come out from. And of course, what will the physician do with the information from MIB? Information from MIB is not only about medical, it has a lot of information there. The physician may not need it for anything. So, but in this answer, you cannot give it to the agent. The agent is far out of it. In fact, the agent is far out of it. You can't give it because it's a personal and secret information. If you go according to HIPAA, the agent is not supposed to handle it. Then you cannot go and give it to the National Association of Insurance Commission, which is NIC. If NIC is collecting medical information from every applicant, they will not have room. They will not have room to what? Please lower your radio. If you are here, just lower your radio so that people will not be distracting people. So the MIB, they cannot go to NAIC, which is National Association of Insurance Commissions. If all the applicants of life insurance go, their result or their information go to National Association of Insurance Corporation, they will not have room to accommodate them. So that one, they are far from it. Then the applicant's spouse, of course, you cannot get MIB information to go and give the applicant's spouse. What is he going to do with it? Remember, this is a secured information that you cannot give anybody. Giving it to NIAC, which is National System of Insurance Commission, is above odd. Giving it to agent is above odd. Giving it to applicant's spouse is above odd. So the likely person who may keep it secured is the applicant's physician. So, but does it mean that this information should go to the applicant's physician? Some of the information come from him. So why must we get them again and submit back to him? So, but the only one that can secure this information, if you can think about the HIPAA, which is keeping personal information intact, the only way this information can go is applicant's physician. I hope everybody understood that.
Right, no. That's why I opened my line.
Is everybody understood that?
No.
Yes.
Because I'm trying to analyze the answers, So the only one we think that is possible here is the applicant's physician.
Yes.
Based on the analysis here, because three other ones cannot near there. But do you think you can get applicant information from MIB? Some of the information there was submitted by the physician, come from the physician. So you cannot get the information again and go and give back to physician.
I think under this situation, I'm thinking because sometimes the primary physician, especially there are people we call frequent flyers, who some of them they go to this person here and then they fly to another person, and sometimes the primary physician don't get all the information. So sending it to the primary physician is for verification. if you are the primary physician for this patient, do you know this condition about this patient?
All
Yes.
right. All right, so she is telling us now in terms of what is happening on field, which is correct. So the knowledge, in every knowledge you get is helpful in any area you are. So let me tell you, in this question, if she's writing this exam, she will pick the applicant sufficient and go, and that's it, and that's the correct answer. But for all of us who doesn't have this idea, we'll be battling on it. So what she said is very, very correct as regarding to what is on the field. Yeah, it's very, very correct. So, but for some of us who does not have idea of what she said, we spent 5 minutes on this kind of question because you do not know the one that you can pick in this question. None of them look real. If you're looking at it from the far angle of not being aware of what is going on in the field. In fact, this question, you may stay there for 10 minutes. You have not answered it.
Yes.
All right. All right, let's go to one. This one is D. The agent met with a prospect and ended up selling an insurance policy. While filling out the insurance application, D makes a mistake. In this situation, D must do what?
Correct the information with no further action from prospects necessary. Correct the information and have the prospect initiate the change. Request that the insurer issue the policy with a rating.
B.
That's B like in boy.
Some two persons say B.
B, yeah.
B.
All right. So contract, correct the information and sign the prospect initial. They call it. Yeah, of course, there's another thing I want to say. In some of these questions, particularly this one, you may see maybe the applicant initiate the correction and requiring the agent to initiate the correction. Yes, two of them can initiate it. In case you see it, don't get freaked out. Two of them can initiate it. However, the applicant can initiate it. But if there's a mistake, the agent can initiate, the agent and the applicant can initiate. So if you see an option where they say the applicant initiate, good. But if you do not see where they say the agent initiate, the only option you see there that's correct, that looks correct is agent and the applicant, or the applicant and the agent initiate, is correct too, please. But if you see only the applicant initiate, then it's correct. So just understand that so that we will not confuse you if you see in the exam. So T applies for a life insurance policy and is told by the producer. The producer is the agent, you, and the field underwriter, that the insurer is bound to the coverage as of the date of the application or medical examination, which is later. Assuming that T is an acceptable risk, what item is given to T?
It says, assuming that T is an acceptable risk, what item is given to T? Warranty, conditional receipt, binding, backdated. Is that
C.
B?
C. I was just C.
No, binding is not yet. I say B.
Any other person?
B.
Okay, nice. So two persons say B. Well, first of all, is there anything like warranty
conditional,
receipt?
yes.
Is there anything like warranty receipt? No. Is there anything like backdated receipt? No. We're only talking about conditional and binding receipts. At what situation do we do binding receipt, and at what situation
After
do we do
approval.
conditional receipt? So these are the things you have to know. So B is the answer. An agent gives a conditional receipt to a client for an insurance policy after collecting the initial premium. When will the policy become effective?
When the condition of the receipt are met, the date the sale appointment was made, the date of policy delivery, when the policy is issued, When the condition of the receipt are met. Eh?
Hey.
Eh?
Which one?
Eh?
All right, two people say A.
Yeah.
All right, when the condition of the receipt are met, of course, upon policy delivery, a signed good health statement is requested from the applicant. Why would this be necessary? A signed good health is requested from the applicant.
The
Remember,
initial
this is the same
premium was
applicant that have
submitted
submitted
with
all his
the
information.
application. The application shows an unusual. The applicant is suspected of making a material misrepresentation. The initial premium was not submitted with the application.
Would that be C? C as in cat?
The suspected of making material
Somebody say
misrepresentation.
C. Any other person?
C.
The applicant chose.
The initial premium was not submitted with the application. So the answer is D. It said, upon this policy delivery, a signed good health statement is requested from the applicant. Why would this be necessary? The initial premium was not submitted with the application.
Okay, I have a question here.
Go ahead.
Does it mean that if the application was submitted with premium at the initial time, does it mean that the statement of good health will not be delivered?
Yes, yes.
All right. That is a very good question. Let me say something that will help us understand it better and more in terms of our exam. This question is just like the other question somebody narrated to us what can happen to a physician collecting those documents. So a policy is delivered. If upon policy delivery, a signed good health statement is requested from the applicant, why would this be necessary? Remember, initially, when you submit this application and the policy is approved, literally, during the free look period, that's when they seek to get this statement of good health. Did everybody follow me on that?
Yes.
Because when you're going to sign the statement of good health and delivery receipt, which you go give back to them, after the free look period, you sign this and submit back to them. In fact, I'm going to submit one of the policy delivery and statement of good health. I'm going to sign one today, which I'm going to go and mail out now. So, do you remember this happens when the policy was delivered? But now the question is this: why would this be necessary? Look at the option. The initial premium was submitted with the application. If the initial premium was submitted with the application, we now talk about it has not reached to policy delivery. Then applicant choose an annual premium mode. It does not have anything to do with this question. The applicant is suspected of making a material misrepresentation. That does not have anything at all. It doesn't have anything to do with submitting statement of good health. So this three, it's just like what I think you are the person that gave us explanation to that last question. Just that this is exactly what it is. This question doesn't have anything to do with these three answers.
Yeah.
It does. In fact, it's totally out.
I have a question, sir. Can you submit a premium without an application?
Of course.
Yeah. Yes.
You can pay without
a
filling out the
premium
application?
without an application?
Yeah, that's what I've been saying since morning.
Listen, he says premium without application.
Oh, no. On what basis? No. No, you cannot.
You can submit application without premium,
premium,
but not premium without application.
Yes. Yes. So remember on the
Thank you. I misread the question. I misread the answer. Thank you. Sorry.
So remember on the consideration clause, which is the makeup of a contract. The consideration clause is the makeup of that contract we're talking about. The insurance contract, which is between two people, the insurer and the applicant or the policy owner. So remember, these two considerations has to be enforced before we even talk about anything. Particularly the consideration clause from the applicant. That of the insurance company, the insurance clause is always there. The insurance companies have written the contract, waiting for
But
you
it
to
has answered the question, actually. When we read this thing, you see, I remember I was trying to find out if this, it seems to be that each time application was submitted without premium, eventually when a policy is issued, this statement of good health will also occur. If we read what they,
yeah, of course. What you said is the correct thing.
It
See,
says,
let me tell you, there's some applications you can submit now in the next 12 hours. In fact, within 2 hours, that is approved. You submit the application now, within 2 hours, is approved. And when the application is approved, you pay the premium. The policy was they will now send the booklet within that same day. In such cases, they may not even be asking about statement of good health. They may not be asking about it.
but we can,
to me.
Huh?
but we
The
can learn
last one
now.
Uh-huh.
The last one applied.
Uh-huh.
The last one applied November. Within some hours, applied. They approved it.
Good.
They do. They have a lot of.
So
So
in that case, they may not need all those things. Because this
No,
is
they just few days they send me this thing online, so I just signed it and that
all
was
right.
it.
All right. So you can imagine.
So we can learn now that when application is sent without the premium, that is usually when we will have the request for good health after the conclusion of the whole thing.
Yes. So I want everybody to, the conclusion of this discussion now is this. If the application is submitted with the, if the application was not, if the initial premium was not submitted with the application, which means the application is submitted without initial premium, that is the one they will look for statement of good health.
Statement of good health.
That's what everybody should know. If the application is submitted with initial premium, there is no request for statement of good health.
Yeah.
So this is what this should be a general conclusion.
Yes.
So let's go ahead.
Makes sense.
So which federal law allows an insurer to obtain an inspection report on a potential insured? Which federal law? What is this?
So what is going on there?
Which federal law allows an insurer to obtain an inspection report on a potential insured?
Oh my God, is that fair?
If you look at it,
fair
check
credit?
which of them, what you ask yourself, which of them is federal law here?
Fair credit report?
I think some people say
B.
No.
So it's just like that thing I was saying, use elimination. This kind of question, you don't need to waste time. You ask yourself, which of this is a federal law? Federal law is an act. Medical Information Bureau is not an act. Freedom of Information Act, I have not heard about that in insurance. Medical Information Act, I have not heard of that. All along, we have been talking about Fair Credit Reporting Act. That's what we have been discussing, which we say is Act of 1970. So based on that, you just get your answer correct. You always use elimination. Then this one says, which of the following correctly explain the action an agent should take if a customer wants to apply for an insurance policy?
Complete the application over the phone and have the customer fill the, have customer sign and, so C.
Have the customer fill out the application and send it to his.
Somebody says C, another person supporting that.
It out to the insurance company. Have the customer sign a plan.
Somebody says C, anybody supporting him, so we can move ahead.
B or C.
You cannot do that in exam.
Yeah.
It's a process of elimination.
Somebody's already CC, so we need support.
Complete the application and review the information with the customer prior to obtaining the customer's the application out to the insurance.
B.
D.
Stupid said B. All right. So we say complete the application and review the information with the customer prior to obtaining the customer signature. Of
Yeah,
course,
B.
then send the application
very
off to
good.
the
You have to review with the customer first.
Yeah, you have to. And again, when the application is approved, a policy is issued, you have to do again what we call policy review with
Before
the
life
now insured
insurance
person.
policy is
So when you
issued,
finish
which of this
application,
component
you have to
of
review
the
it with the customer.
contract is
Again, when the
required?
policy is issued, remember a counter offer can be met.
Attending
You still have to review
physician's
the policy with the
statement,
customer.
applicant's signature, a conditional receipt, beneficiary's signature, attending physician's statements, applicant's signature on application. For a life insurance, which of the that's A.
Any other person? Any other person? All right, somebody.
I'll say C because talking about the contract.
So one person say A, one person say C. We need support from either of the answers so we can move ahead.
Before a life insurance policy is issued, which of these components of the contract is required? Yeah.
Somebody says C, somebody says A. So we need a support so we can move ahead.
So
B.
you need, I think you
wrong. I don't know.
ABC. ABC is three answers. So we first choose one person to support either of the three so we can move.
Come on. Somebody say something. I say A.
No.
All right, we have to do
Okay, I'll
something.
support C. Let's go.
B.
Yeah, it's B,
All right,
right.
say C.
Nobody was supporting me for B, so I went for C. I test
my own B's answer in the
nobody was supporting me for B.
So
And
I said B. I said
nobody was
B.
supporting me.
I said
So
B.
Because without the applicant's signature, it's not valid.
Yeah, I said
Yeah.
B. Oh, yeah, I got it.
All right, so before a life insurance policy is issued, which of these components of the contract
Yeah, it
is
should
required?
be.
Sometimes.
There's nothing like attending physician statement.
Good job, my sister, for sticking with your answer.
There's nothing like beneficiary does not have anything to do with the contract. The conditional receipt does not have anything to do with that. So the applicant's signature on application must be there before it can be submitted. In fact, before even anything can be done, that person must have to sign that, look, I gave all this representation, I gave all these statements. So if not, that application is null and
makes
void.
sense. Makes sense. Makes sense.
And of course, you, the agents, have to sign. It's a contract.
For life
The
insurance
applicant
policy
signs,
on
you, the agent,
herself
sign,
and
representing the
submitted the
insurance company.
initial premium with the application. She is given a receipt by the agent stating that coverage begins immediately if the application is approved. What kind of receipt that is? No, no, that is conditional. That's conditional. That's it.
A.
Two persons say A, one person say A, one person C.
Conditional.
It's conditional. It's C.
Can one person support some of these two? So,
C.
two people say C.
Okay.
One person say A. Two person say
A.
We can follow two people, not two persons.
It's C.
So the answer is conditional. It's not binding.
Okay.
Binding receipt Remember,
my sister is strong, but she nearly confused me.
all right,
Sorry.
let me say something about binding receipts. Binding receipts is every insurance company is scared of binding receipts.
Mhm.
Oh, okay.
Because if you give a binding receipt, what it means that this receipt, this contract is already binding, is already enforced, even before the application, before everything is analyzed, which means if that person dies that time, you must pay benefit by force because the contract is already binding. At the binding contract, no other person can make a change. You, neither the insured nor the insurance company. If the insurance company want to make a change, they have to get the consent of the applicant. So binding is very dangerous. Most insurance companies are scared of it. You can also see binding receipt in health insurance. But in life insurance, they are scared of it because it made them to pay claims that they're not supposed to pay. Remember, insurance companies are in the business, they don't want to pay money. That's the truth. But however, the clauses and the provisions here mandate them to consider their promise, which is promise to pay the benefits, which is their own insurance or consideration clause. So, in other words, no insurance company left alone we want to pay. All right, go back to your auto insurance. If you have an accident, you take the insurance questions before they can come and fulfill their own terms, which is to repair to fix your car. So that is what it is. So they are scared of binding receipt. No insurance company will give you a binding receipt. No, they're scared of it. So conditional receipts, of course, is upon condition of so thing happen. All right. So upon delivery of a rated life insurance policy, the producer must obtain each of the following except what? The producer is you.
The required premium, sign the HIPAA disclosure, signed amendment, and statement of good health. That HIPAA, no, required premium. Yeah, B. It said rated life insurance. Rated means signed.
Another person supporting that?
I don't know what they mean by
This
amendments here.
rated, yeah, this rated.
The amendment, I don't understand.
Amendment on the answer?
The premium.
Yes, I don't know why amendment.
That's your option in the answer. If you think it's not necessary, then you should not consider it.
I think this should be the required premium, because when it's rated, that means it wasn't. It's a kind of.
What policy do we say this policy is rated?
It's a declined one or sub. Oh, you said that.
You have everyone forgotten that when we are doing
substandard.
All right. So when we are doing risk classification, we talk about rated. Rated is either you say substandard or rated policy.
Okay, so
but
it's still a policy. So it's still that's if it's rated, they still did something. It's just that it's on
My
a
answer
higher.
is I tested my answer because I'm at
Somebody
work.
answered answer. Let me see. Somebody said.
So B. You don't need the HIPAA disclosure at that time.
C.
So Chinyere says C. All right. Another person says C.
I don't know what this amendment is, but don't make sense.
So
yes, that's
sign
yes.
HIPAA disclosure. It said upon delivery of a rated life insurance policy, the producer must obtain each of the following except what? So you see, all right, I've not told you guys on this particular in this section.
Amendment.
When you are answering question, pay attention to the word except. No, not. All those words, they sometimes negate the answer. Except, not, no, only. All those words can make answer not to be what it's supposed to be. They negate the answer. So in this case, this question is asking you, which of this is not even tolerated or related to rated life insurance policy? You cannot talk amendment. Signed amendment will be there. Required premium will be there. Signed statement of good health will be there. Signed HIPAA disclosure. Does not have anything to do with the rated policy. Rated policy is a substandard policy. I remember, I will even, that time we were classifying risk classification. We have preferred, we have standard, we have substandard or rated policy. So whenever you see rated policy, they are talking about substandard policy. So this, three of this is involved in the policy, but the signed HIPAA disclosure doesn't have anything to do with the classification or the policy we are talking about. No.
What is the sign amendment? Is it like they are doing correction on the
correction. That's correction,
application?
of
Okay.
course. When there is
Okay.
a correction, there is amendment here.
Okay. Thank you.
If you do any amendment, you have to
initial it.
Either you initial it or you and the agent and the
Initially,
agent and the
right.
applicant
Okay.
initial it.
Yeah, the question is tricky.
So this one said, T is given a receipt after completing a life insurance application and paying the initial premium. Under this section, T coverage is what?
Binding.
I'll say A.
No, it says T is given a receipt after completing a life insurance application and paying the initial premium. Yes, it's A because
I think it's conditional.
yes, A.
All right, people say A.
Yeah, it's A.
Condition depend on the insurance underwriting.
Yeah.
So the reason for backdating the policy is what? What's the reason? Everybody should know that.
To decrease the to obtain a premium rate based on
D.
an early
Yeah,
that
D
D.
as
That
in
D.
dog.
That's D.
D.
Yeah, to obtain a premium rate based on the earlier age, of course, that's the reason. When an insurance application is taken by a producer, which of this statement is true?
Has the discretion to ask or not to ask any of the questions listed on the application of void. Any change made on the application requires the applicants the application should have an attorney present. Oh my God, no. A change made. So
B as in boy.
B.
So the answer is correct. Any changes made on the application require the applicant's initial, of course.
Yeah.
We have been talking about since today. All right, I think that's it. We are done with this. Any question before we close?
Good.
Question? Any question?
Yes, my question is on the YouTube link.
Oh, I sent it already.
How do
I
I
didn't
access it?
receive it.
Let me see. Hold on, let me see.
I didn't receive it.
Yeah, it's already there. Yeah, check.
Today?
Is there?
Where, on the WhatsApp group chat?
Did it?
Yes,
Is it today?
Okay.
Yeah, today. I sent it this morning. Yeah.
Okay,
Sorry.
on the WhatsApp group chat. Okay.
I haven't forgotten. I didn't remember. I'm sorry.
Okay.
All
I
right.
didn't see it, so Engineer
Oh,
Back.
I see
didn't
it.
see
I
It's
see
there.
it.
Check
Thank
your
you.
group.
I
I
didn't see
see
it.
it.
Chidera, you should have it. Are you not in the group?
Thank you.
It's the
I'm in
last
the
thing
group,
that
so I
was
don't
sent
know
in the
whether
group.
you created another group. I don't know.
All right. I will check. I will check your number. I think. What's that your number? Let me see.
240
Mm-hmm.
593 4284.
All right. I will check. If you're not there, I'll add you. Then I send it to you. All right.
Okay.
Any other question?
No, thank you.
All right. See you guys in the evening. In the evening, we're going to start from chapter 8, which is what? The health insurance they give you at work.
Okay.
Yeah,
Group
of
insurance.
group insurance. So it's very, very important for everybody to know it, why you should have it.
Well,
And
Mayor, we want to talk to you. Professor Barth.
Go ahead.
You see that
you.
I didn't get that thing,
Are you in the group? Check on the group. Is there. If you set it on two groups, one is the onboarding, the other one there's a group where you say Bat Royals, and the other one is the group for Royal Start January 2026. So all of them should be there.
All right, all right.
Any of them, just check on any of the group is there.
I think it's only one on Engineer Bat I am. I'm not on the other one.
Oh,
You're
yeah,
not on the other one.
January 26th. January
I'm not there.
2026.
I'm not on that group.
All
Life
right,
and
I
health.
will put
Life
you on
and
that.
health.
Chinyere, I'll put you on that.
You are
Okay.
guaranteed.
All right.
So
See you guys in the evening.